battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to another episode of the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Here we are. It's November the 3rd as I am recording this. By the time you're probably watching it, it's November 4th, episode 133. Hard to believe. We are almost to Investor Day 2024, but it is this year in 2023. Coming up very, very quickly, November 14th and 15th, downtown Naperville, Hotel Indigo and Sullivan Steakhouse. Do not miss it. The Tuesday night dinner, I will tell you, is completely booked. We are at max capacity. Thank you for everyone who signed up well in advance. Also, Wednesday, we have a couple spots open, but we're quickly reaching capacity. I believe we have 10 more spots. So if you want to come during the day on Wednesday, the 15th, for Investor Day to hear about our due diligence portfolio management rebalance process, about 10 spots left. So don't miss it. Can't wait to see you. Going to be exciting. Probably our best investor day yet. This week's episode and article is called The 80's Mistake. If you are not getting the articles, if you're not getting the episodes, subscribe, get on the email chain. You'll get notified when the new episodes come out. Subscribe, follow us on YouTube, follow us on Spotify, follow us on Apple, wherever you like to listen to it. Hit the subscribe button. You'll get notified about the new episodes coming out. This week's episode, The 80's Mistake, is all about the obvious big mistake. And I know it's in the title, but what happened to investors in the 70s who were so scarred from the equity declines off of high inflation that they forgot to get, or they were too scared about getting back into the market for the rally that took place in the 1980s. And it's kind of interesting if you look at the information and the data here that stocks peaked in 1972 when the S&P 500 index was trading around 118 points. By the end of 1974, the market dropped 43%. And that's what kind of happened during the COVID era in 2020. It certainly happened in 08 and 09. Big time drop-offs in equities. And like always, investors got terrified. That's one thing that never changes over time, is how scared everybody gets every time the market goes down. And by 1979, Paul Volcker becomes chairman of the Federal Reserve. So think about the history here. 1972, the market peaks. 1974, the market bottoms. It's not till 1979 that Paul Volcker comes in to the Federal Reserve, and his mandate, his own one and only mandate, is to do what? It's to bring down runaway inflation. Why was runaway inflation so bad in the 70s, going into the early 80s? Well, of course, coming off of the LBJ years, the Great Society, which was a great disaster, which really was fueled by the FDR era when we signed the Federal Reserve Act into existence in 1913. But then in 1971, Richard Nixon completely abandoned the gold standard and took us off a fixed monetary supply. And it's not that gold, or if we ever return to a gold standard, would completely save us. There are issues with fixed monetary supply, but at least back then, you couldn't just print more currency in to existence. So by the time Volcker is appointed, we're off the gold standard, we're on the Great Society, we're on the FDR big spend programs, print and spend. The Federal Reserve printing press is going. Volcker is tasked with one thing: to bring it down the record inflation, the 11% annual year-over-year increases. He gives a speech in the fall of 1979 to Congress that he was going to aggressively fight inflation. Everybody hated him for it. Everybody panicked. Everybody disliked Volcker in the beginning. However, 1981, two-year treasuries reached 17%. Fixed-rate mortgages climbed to 19%. At the exact same time, and a month after a year after Volcker gives his initial speech to Congress saying he's going to fight inflation, the stock market makes a brand new record all-time high in December of 1980. So let's unpack all this briefly and go back through the history one more time. Everybody panics. Volcker comes out in 1979, says inflation's bad, we got to get it under control. Treasuries hit 17% interest, 30-year mortgages, some of you remember this or have grandparents or parents that remember this, climbed to 19%. And you would think that the next obvious likely outcome is the stock market drops another 43%. But that is not the case. The stock market goes on to make a new all-time high. And this is what I continue to talk about week after week, is the fact that the stock market is a forward-looking indicator of what's to come. The market bottoms well in advance of the bad news, and it peaks well in advance of the good news. So by the time you react, by the time you try to time it, and by the time you try to get in or get out, it's already too late. In most cases, you've already missed the boat and you're better off just staying invested. People were so scarred from the 70s, they wanted nothing to do with equities. Our industry was born. The financial advisory industry was born in the 80s. It was born off the boom in equities, and then also the decline in interest rates, where people could no longer sit on a 10 or 15% treasury. They were forced to buy stocks to make return. That's when Wall Street really started moving into Main Street. Conventional wisdom tells us to own short duration assets like money markets, dividend stocks during high inflation environments, and long duration assets like longer term treasuries and growth stocks during low inflation environments. And we've talked about this. It always makes sense to have a little bit of dividend income, but sometimes it makes sense to have more dividend income if we are in that rising rate environment. The problem is all of that, again, happens in advance. Future profits are discounted by risk-free rates. Long duration assets pay less. They're worth less. If you have to wait 10 years for a growth stock to turn around and pay you a return, it's worth less when rates are higher than when rates are low. That's what happened during COVID. When rates were near zero, you have a lump sum pension, your pension went way up in value because it's a long-term asset. And what else went up? Tech stocks. Tech stocks rallied during COVID because rates were near zero. Hard to believe. But during 2021, a 2-year treasury paid 0.12%. That same 2-year treasury today pays over 5%. You'll remember names like Peloton, Traeger, Carvana, Shopify, a host of other technology booming names that we said were unsustainable, trading for astronomical prices. At the same time, people owning dividend-paying stocks with a lot of cash flow, real businesses like Exxon, Walmart, Procter & Gamble, just steady plow horse growth companies traded for extremely cheap multiples like they were about to go out of business. And those are the excesses that existed in 2020, which are not unlike the excesses that exist today in this market in 2023, where a lot of those good companies are still trading at significant discounts. And it's the same thing that I said. If you go back and watch all of our shows from the end of last year, when I wrote articles that stocks were cheap, I said that you should be buying big tech, when Amazon was trading for dirt cheap prices, when Facebook was trading for $90 a share at a 7 forward price to earnings ratio, trading cheaper than a value stock, I said buy, because excesses in the market happen about every 3 to 5 years. When price to earnings ratios get unsustainable or unsupported by growth metrics, that's when you want to buy. And when price to earnings ratios are too high and it doesn't make sense to own a stock for 300 times earnings, that's when you want to sell. Here's the one catch. The tech trade sold off last year. So if you thought interest rates were going to keep going up in 2023, which they have, they've actually gone up more in 2023 on the long end of the curve than on the short end than they did in 2022. You would have said, I'm going to sell tech this year. I'm going to do the opposite of what we said in Weekly Insights in the show. We're going to sell technology and we're going to buy bonds at the end of 2022, anticipating higher interest rates. What a mistake that was. That trade already happened. And this is my point, is you cannot time the market with consistency over the long run. If you could, you would be buying at the lows, you'd be shorting at the highs, you could turn 10 grand into 10 million within a couple of months. Nobody's done that successfully over the long run. Over time, markets favor patient optimism. Buying low, selling high. The problem is most people don't do that in practice. Most people sell when things are down and they buy back in at the top. And so here we are today. Big tech is up. Technology in general is up. We're having a rally of all sorts, all kinds coming back. The market's breadth, that means the sectors of the market, the pockets of the market that weren't doing as well before are now rallying. We got some economic data today that was actually negative, and that's why stocks are up. It actually means that bad news is good news because we had a softer jobs report than expected. So people are saying, okay, we're going to get a little bit less Fed hikes. The Fed said it themselves this week. They said we're not going to raise rates as quickly as we have, and maybe we're going to pause for a while, which is good news. I do think they should pause. And I will agree with two of the people that are actual portfolio managers out there. And I've consistently distinguished between portfolio managers, people who actually have to put dollars to work and produce a report card of what they've done, versus market strategists. Don't listen to the strategists. Why? Because the strategists never have to be right. The strategists are out there on CNBC or Fox Business or Bloomberg saying whatever they want, trying to get some marketing for the company, some airtime, okay, trying to get their name in lights. Don't listen to them because they don't actually have to produce a performance report. They don't have to show you how they've done, although we do track them just to see. They haven't done well, I can tell you that. What you want to do is follow portfolio managers. There's two in particular. One is Jeffrey Gundlach, and I'm not saying listen to what these guys say because they are selling bonds, and inherently people selling bonds are pessimists. They're negative. They're always going to be sort of bearish on equities because they want you to sell your equities to buy bonds. But regardless, one of the things that Jeffrey Gundlach said, who runs Double Line, it's a big bond shop, $100 billion bond portfolio, and the reason I think he's right is he said that the Fed constantly drives off the cliff looking out the rear view mirror at 100 miles an hour. And you got to be so careful if you're running the Fed, if you're trying to look at interest rates and trying to look at the economy. And this is why centrally planning the economy is impossible. You can't do it consistently. No Fed chair has really been able to do it well. We've really never ever had a soft landing before. The reason why is because all of the data that the Fed looks at is in reverse. It's all, this is what happened last quarter, or this is what happened last month, or this is what happened 6 months ago. And because of that, they can't actually assess where we are in the current cycle. They're always looking backwards, not forwards. Gundlach's point, which I agree with, is that a lot of the rate hikes that have happened so far are not going to have a full impact on equities, on the stock market, on the U.S. economy for a few more months to come. And there's about a 6-month lag. Some people think it's a 1-year lag. I think there's even some economists at University of Chicago that say there's a 2-year lag, which to me makes a lot of sense. If you look at the COVID era, there's basically been a 2-year lag. All the policy that was put into place in 2020 came home to roost in 2022. All the policy in 2022 is now coming home to roost, I think, in 2024. We'll find out. We were not there yet, so we don't know. But that's where I think we're in this cycle, is the Fed should pause. And I think one of the problems that they're going to have is if they cut and they go back down the other side of the mountain with interest rates, they still aren't going to solve a lot of the big supply problems in the economy. We've got two major supply problems. Number one is labor. We got to get more workers. We got to get more people back to work. There's a lot of people who dropped out of the workforce during COVID that should be coming back. People that maybe retired too soon, or people that were worried about getting COVID. A lot of that's coming back now. We're getting return to work. We're getting people realizing they don't have enough money. They maybe thought they could retire. They're realizing, hey, a sandwich is $17. This is crazy. I got to go get a job. So you're getting some of that, which is a positive. And then I think the other thing you're going to see is housing supply is going to be a structural issue, not just created during COVID, but exacerbated during COVID, created during the housing crisis of 08 and 09. The stringent regulation that was put on developers in 08, 09, and 2010 after the fallout last crisis we had underbuilt housing. We had undersupplied housing markets for over a decade. And because of that, we do not have enough places for millennials to live. All the millennials who were, maybe they were like 21 or 20 years old in 08 and 09, or even younger, 18, 19, they're all at the age now where they're looking for houses. And because of that, we just don't have enough supply. Dave Ramsey, who I also agree with on this specific point and a lot of other things, he came out and said, hey, buy a house now. Don't worry about the interest rate. You can refinance down the road. Housing prices in 5 years are going to be higher than they are today. And he highlights all the supply issues. I kind of agree with him. I think that's correct. So you got to do it within a plan and be a little bit careful about what you're doing. You don't want to just completely knock yourself out with the house you can't afford, of course. But, I do agree. Those two issues, labor supply and housing supply, are going to be upward pressure on inflation. So stay tuned on inflation. I think we're going to continue to see more housing price increases. You'll see wage price increases to the point where next year, and I try not to be overly predictive and overly trying to tell you what's going to happen, but I do want to give you a little insight into where I think maybe 2024, 2025, 2026, where we're going. There are going to be layoffs, and they may not happen at Amazon or Microsoft or Netflix or Facebook or Google or any of the big tech companies, although there could be some of that. Most of it, I believe, is going to happen at small caps. You're going to see small cap companies that mismanaged through COVID. They bought too much inventory. They took on too much debt. They didn't fix their debt at low interest rates, and now they're on revolving loans that are increasing, are going to face issues. We've been analyzing the balance sheets of a number of small cap companies right now, and it doesn't look good. They're underwater. They have negative equity sometimes on their balance sheet, which means they have more liabilities than they have assets. That's not good. And so I think you're going to see layoffs in small caps on a wide scale start to occur. Companies are going to have to tighten up. The saving grace has been large cap US stocks, and not even just all large caps, but the top 50 names. And you know this, we've sort of had a top 50 strategy with the portfolio. We've said, hey, we believe in cap weighted investing. We believe that the biggest get bigger. We believe that the top keep going higher to the top, and that the small keep getting smaller. And one of the problems with small caps is they lose their best players. They trade their best players away, because once a company gets good enough and big enough, they become a mid cap. So they leave the small cap index. Okay, so then after they become a good enough mid cap company, then they maybe even become a large cap. So we've taken the position, why do we want to own these companies when they're tiny and it's fraught with risk and all this stuff? People say, Nick, you can get pretty good returns on small caps. Well, if you look at the empirical data now, especially in the environment we've been in the past 10, 15, 20 years, large caps continue to get bigger and bigger and bigger because of regulation, because of taxes, because of all the problems we have in DC. And that's where we want to be. We want to be in the companies that are going to beat the inflation, going to beat the regulation, going to beat the taxes, and that's large cap. So if you're a cap-weighted investor, you think that the best are going to continue to rise to the top. You like the S&P 500 because of that. My advice has been, well, why own all 500? Why not just own the top 50? Because statistically, you're leaving that much return on the table. And empirically, if you look at the risk metrics now, to own the top 50, you take on 1% more volatility versus all 500. And the returns have been much better. So this is where we say the big will get bigger, the top will continue to go to the top, and the best companies will continue to make it through the crisis. The top companies today have so much money, so much net interest, meaning that the money that they earn on their cash, remember 5% or 5.5% risk-free on their cash. In some cases, that interest they're earning is higher than the interest they pay on their debt. So the Fed thought, hey, we'll raise interest rates to the point where we'll slow down company growth. These companies haven't slowed down. They've actually had a stimulus from higher interest rates. And so again, this is where I go back to, I know I say it almost every week, but you cannot centrally plan the economy over time. You cannot have that. You need free markets, you need entrepreneurship, you need people to be able to make decisions, make mistakes even. That's capitalism, that you should be able to fail. No company should be too big to fail. The minute you do that, and you guarantee that a company's too big to fail, that's you're on a slippery slope. You're on a bad path towards actually Marxism, believe it or not. And what you need in true free markets and true capitalism, not crony capitalism, but true capitalism, is you need companies and entrepreneurs to lead the charge, not a centralized body of planners. Unfortunately, that's the reality we deal with, so we have to talk about it. So that's Volcker. And I think the reason that stocks rallied amidst Volcker's inflation fight, remember, Volcker started out his career as Fed chair, hated. He's looked back on pretty much, maybe not adored. I don't know how much you can really adore a Fed chair, but people, kind of look back fondly on him in the history books. The reason stocks rallied during Volcker's inflation fight, and also why I think they haven't plummeted in 2023 yet, is because markets are consistently that forward-looking indicator. Investors who experienced the equity bloodbath in the 70s, that wanted nothing to do with stocks in the 80s, ended up making a huge mistake. And it's like Shelby Davis of Davis Advisors pointed out, who started, they've been around through these entire cycles, 60s, 70s, 80s, said most of your money is made in a bear market. You just don't realize it at the time. That's the reality of 2022. When we said to buy companies because they were cheap, the S&P was trading at 3650, and we don't always catch the bottom, but for whatever reason we did when that article went out. I said buy stocks, and buy the big ones because they traded off, buy technology because it was cheap. Sure enough, it rallied. It's just math. It's just that stocks sometimes get out of whack with earnings. When earnings go up faster than price, stocks are cheap. When price goes up faster than earnings, stocks are overvalued. It's not radically complex. Think about this. From the end of 1979, when Volcker started his aggressive rate hike campaign, to the end of the decade, 1989, the S&P 500 produced a total return of 283%, including dividends, one of the best periods in history to be an equity investor. Give that some thought. Again, 1979, the Fed chair comes in and says, hey, we're going to aggressively fight inflation. We're raising interest rates. 2-year treasuries are 17%. 30-year mortgages are 19 to 20%. And stocks go on to produce the best decade they've ever had. One of the best decades. That's the reality of stocks being a forward-looking indicator. Many investors missed the 80s. They made the 80s mistake because they preferred double-digit yields on treasuries and money markets while ignoring earnings yield on the S&P 500. And so not only do you want to look at dividend yield on companies, dividend yield is what they pay out in excess of what they earn on their earnings. Earnings yield is also important because that's how much the company makes in profit on its market cap. If you look at earnings yield on the S&P 500 during the 80s, you would not have missed the rally. From 1983 to 1989, earnings yields hovered around 8.5%, while the real inflation-adjusted return on bonds dropped into the 4.5% range. That's the problem with the bond market. As soon as rates go down, yes, prices rally, but the yield you get on the bond goes down. And you think, oh, I'll buy a 10-year bond for a 5-6% yield. Nick, I'm going to lock in 10 or 5% for 10 years. Good luck. Most people don't do that. It works in theory, but in practice, nobody really holds their bonds to maturity. You need money, things come up, stuff happens. You're almost always better in the equity market. Like Dr. Siegel of the Wharton School pointed out in his book, Stocks for the Long Run, on the shelf behind me, stocks are always the best hedge against inflation. When you add earnings and dividend yield together, equities present a far better yield for investors, a better real return. Real means after inflation today and also during the 80s. So why do people miss out? People like to take guarantees over future profits. And so, yes, it's nice to have a guarantee in life, but there's always a price to pay for a guarantee. A guarantee is a form of insurance. In the stock market, there are no guarantees. As an investor in equities, there's no guarantee you're going to make money. But that's why you have to go off of data, mass statistics that would favor patient, long-term optimism. While money markets pay far less in 2023 than they did in 1983, rates are much higher than they've been in recent history. And that's where people are starting to say, I can get 5%. I can maybe even get 6% risk-free. I'll even buy a long-term bond. Barron's Magazine front page article the other day said that this is one of the best bond buying opportunities in history. Now, we're not market timers, so we're not willing to make the same call that Barron's did, but I just return to our principles, our core beliefs that not bonds, but rather stocks are the best claim on real assets. They are the best inflation producing hedge over time. Inflation beating hedge, I should say. By the way, not everything that goes on the front cover of Barron's turns out to be true. The day that the dollar peaked, Barron's had basically an iron fist on the front page of the magazine saying that the almighty dollar, that was the day that the dollar peaked. So not all the things that people say actually happen. It's certainly not with strategists. And sometimes you can't even blame them. These guys who get out and they're supposed to make a call every week or every month or every day, how are they going to be right? It's statistically not possible. Instead, the way to be right in the stock market is just be optimistic. Say, hey, if I'm going to own stocks, if I'm going to buy companies, I'd like to own companies that are probably going to be around for a while. So I like to own the biggest and the best with the best balance sheets, the best ROE, return on equity, best ROA, best return on assets, and some dividend yield. And I'll hold a diversified basket of them. Maybe I'll hold 10, maybe I'll hold 20 like we do. We hold 50, maybe I'll even hold 100. And over time, if more of them go up than go down, you make money. That's just simple math of investing. So the fact is, you can buy a money market right now that is true at 5% nominal, which means before inflation yield. However, real yields on money markets, if you subtract inflation, are just 1.3%. So yes, 5% before inflation, only 1.3% after inflation. At the same time, earnings yield on the S&P 500 for next year is projected to be nearly 6% higher than the 5% yield, with dividends included. Dividend, let's say, is 1.5% to 2%. Earnings yield is 6%. In some cases, if you have a growth company, it's 8 to 10%. All in, stocks will continue, I believe, not a guarantee, but going off of data mass statistics, yield 8 to 10% before inflation per year. So yes, you can earn 5% risk-free, but the problem is you cannot eat risk-adjusted returns for dinner. You can't put risk-adjusted returns on your table. Okay? You have to have real returns after inflation. So when inflation subsides, and I think there's a lot of evidence that a lot of inflation is going to subside and yields are going to fall, maybe not in 2024, but definitely by 2025, I believe stocks will continue their upward climb like they did during the 80s. And while it may not be a 283% decade, I do believe we are set to have one of the best decades we've ever had. Yes, despite all the problems. I know all the issues. I know about Russia, Ukraine. I know about Israel. I know about all the things going on. I know about China, Taiwan. You go, Nick, what about all these problems? We have always had problems in this country. We had the problems in the 50s. We had problems in the 60s, problems in the 70s, problems in the 80s, the 90s, the 2000s. We've always had conflicts. We've always had problems. And I know it feels a little bit different today than it did back then. But to those people, it felt different to them than it did 20 or 30 years prior as well. And so the one constant has been, number one, human nature never changes. People always behave the same way over history. And then number two, that despite all the bad news, despite all the negativity, despite all the doom and gloom, stocks have continued their upward climb. I believe, like the 80s, you may not have a chance to react to a stock market recovery that is ensuing today. Right when everybody was bearish and negative, the stock market went on to have one of its best weeks on record this week, up over 5%. And while stocks may correct further from today's level, the S&P's price of 4,300 points, I believe stocks are cheaper than they have been in the past 5 years and the past 10 years, and that equities will continue their upward climb over the long run. So stay patient, stay optimistic, stay bullish, don't panic, don't get off your plan, and don't just hide out in the 5 or 6% treasury with all your money and get so nervous that you never buy stocks. You don't want to be like the people in the 80s. You want to be in equities. And if you can't stomach the volatility yourself, hire somebody, get a fiduciary financial advisor like ourselves or somebody else you trust, and just make sure you're on a plan. And I think over time, patient optimism will be rewarded. Thanks so much for being with us. Episode 133. We will see you next week for episode 134, and hopefully see you at Investor Day, November 14th and 15th. Take care. We'll see you next time.